All right, next we have up Anthony Vassallo, the Senior Vice President of Crypto at Silicon Valley Bank, for a fireside moderated by Sonya Kim, the chef at Steakhouse Financial.
Hi, Anthony.
Howdy.
I was actually really excited for this fireside chat because Silicon Valley Bank was not the name that I expected to find at Stablecoin Summit. So, we obviously all know the story of SVB during the regional banking crisis in March of 2022 or 23, rather. Could you give us, for the audience, an update on how the bank had progressed since the acquisition by, it was First Citizens Bank, right?
Yeah.
And what the crypto team at SVB is currently focused on.
Yeah, sure. Thanks, Sonya. So I've been at SVB for 9 years. I've done a number of different roles, mostly on the commercial lending side, underwriting, portfolio management, and then a product manager looking after tech and healthcare lending, and always looking to do more for our crypto clients. So we've been banking the space for over a decade, more publicly for about the last 4 years. And following the acquisition, First Citizens has kept us intact. Same bank that you know, more diversified balance sheet. Over 80% of SVBers are still at the bank. Our private bank merged, and our commercial bank has remained intact. As for our dedicated group, we have a dedicated Fintech arm, and within that is our crypto practice. And we focus on helping about 500 companies, crypto-focused VCs, and those building on and around the blockchain. So First Citizens was really impressed with our processes, controls, and see this as a meaningful growth opportunity for the bank as a whole. And the types of companies that we support span from miners to marketplaces, wallet providers, networks, foundations, you name it. So long as they have some sort of a basis in the US and have raised outside capital, we're happy to take a look at them.
Very interesting. So you guys are open for business for crypto companies wanting to bank with Silicon Valley Bank. Very nice to know. So the discussion for today was going to be on stablecoins.
So one thing that we did at the end of last year is separate from all the other reports that you see with folks looking what you're seeing for the year ahead. We thought a lot of topics were covered to death, but we wanted to focus on 3 things that we thought were particularly interesting. One was payments and the convergence of blockchain and fintech. The other one was decentralized AI and AI's increasing role in crypto innovation, and finally, gaming. So I'll hand it back to you with where you want to start here.
Yeah, so as the slides show, crypto payments are actually gaining a lot of adoption. And I was interested to hear from your vantage point how you're seeing the adoption of stablecoins and what areas within the stablecoin ecosystem is the most interesting to banks and fintechs.
Yeah, at the most basic level, you think about what is the utility of a blockchain, and payments make sense. Blockchain being the rail, stablecoin being the asset that runs along it. And in the last 5 years, you've seen almost a 40x in volumes. Biggest acquisition to date, Stripe of Bridge, happened in October. You're seeing a lot of companies raise around this, and I think it's remiss for fintechs to only observe what's going on in this space and to have a strategy. So what we're seeing is a lot of companies coming to us that have recently raised or are about to raise or are beginning to support stablecoins in some way, and we help them with their commercial needs. So what's really interesting here, I think we all know, but if you look at this as an American, you miss the point. What we might consider micropayments are truly essential for regions in sub-Saharan Africa, India, LATAM, especially Argentina, where small businesses and individuals actually need to correct for the volatility and have a way to transact. So I might just skip ahead here to this one, which was discussed earlier in the panel. Now, one thing that's interesting here is Visa is one network. So, to be fair, but it's a pretty big number, right? 2.1 trillion monthly stablecoin transfers. So what we're seeing here is this is the direction that we're obviously headed, and we're passing the processing benchmarks that you're seeing on these traditional rails because they are better.
So my personal thesis of how DeFi grows is through the DeFi of Mullet. I'm sure all of you are quite familiar with the terminology, but it's essentially leveraging, CeFi in the front, so the distribution power of these fintechs who are interested in getting into crypto, and DeFi rails really powering the back-end architecture of these new, solutions where CeFi and DeFi meet. And I was wondering if you have any kind of like tangible examples or, anecdotes of some of your fintech partners or banking customers wanting to get into this sort of, meeting of CeFi and DeFi realm.
Yeah, so we're obviously seeing the convergence of fintech and crypto, and it kind of begs the question, what was and what is fintech? What does it all mean on a definition basis? I think the fundraising data speaks to this pretty solidly. So if you look at the bottom here, this is a kind of a consolidated taxonomy that we use internally and via PitchBook. And looking at the valuation overhang from 21 to 24, this goes right to left, is something you should notice. If you look at the way that these categories are broken down, the least recession in a single category was crypto blockchain. And a lot of these, by and large, are companies that are processing payments or doing something around stablecoins. What's interesting here are these are companies that either self-identify in this category, said so upon a fundraising announcement, or specifically in a product release. So if a company doesn't first identify as it, but they are playing into the Mullet, where they are using the blockchain in the back, that would count as well. And if you look at the chart on the top, that also begs the question, should we be measuring the crypto blockchain footprint as a portion of fintech? When will they separate what means what? My personal take is I don't believe this chart on the top is a triple top and has failed and is going to sink. I think you'll see that continue as well. And just a general footnote on what you see with fundraising announcements is these lag, right? So you have the lag in reporting, and then you have the lag in the announcements. Several companies elect to not announce until 6, 9, 12 months after they raise, whether that's alongside a product release or they're trying to do something more strategically, but the funds have already closed, and then they'll come along that as well. So I would guess, we'll see as more time passes that this is going to grow even more. And I think it's a way that some of these fintechs are also trying to reach new users and improve their cost structure.
That's so interesting. So for the audience, in case they can't see the labeling on the bottom left chart, is the right way to read that chart that out of fintech deals, crypto and blockchain subcategory was the highest funded or the most popular subcategory?
Yeah, there's a little bit, this is an attempt to be mutually exclusive and completely exhaustive. So it depends, chiefly, is it a payments-oriented fintech or something like that? But I think the main takeaway here is that those that were identified as having a nexus to blockchain had less suffering in what we saw from 21 to 24, and we would continue to see more of that restoration as fundraising comes back. And this is a trend that we're all familiar with at VC as a whole, but this just focuses on that fintech slice.
Okay. And since you represent TradFi, this morning I read that the CEO of Bank of America, the second largest bank in the US, came out and said, contingent on legislation, making progress, we are happy and ready to jump into the stablecoin market. And I was wondering, on a 3 to 5 year view, right now we've got a market structure which is led by Tether, USDT, followed by USDC Circle, and then the distant third would be a decentralized stablecoin, DAI or USDS. We've been quite used to this market structure perpetuating over the last couple of years, but it feels like as TradFi comes in and they launch their own stablecoins, the landscape might evolve quite substantially. So I was curious what your view was on a 3 to 5 year basis, how you envision the stablecoin market panning out.
Yeah, I mean, I think so. Generally, as you see expansion in crypto markets, the demand for stablecoins continues. So you see more minting than redeeming. I think there's a lot in here in the ethos of crypto specifically. What's a true 10x improvement around an incumbent solution? How many tokens do we need? What's the differentiator? And I think a lot of that applies to stablecoins as well. So I think obviously it will continue to grow for just the obvious reasons of what it produces as well. On the banking side, if banks want to actually be at the forefront of banking tech companies and fintech, this is a very meaningful opportunity. Now, I think first and foremost, it starts with them actually knowing the customer and the risk profile, the activity that is being requested from the client at the bank, not only what is approved, but how it's monitored. So there's just so many opportunities. If you want to talk from more of a visionary perspective, I think right now what you're seeing a lot of is what can they do on the deposit and treasury side, and then the stablecoin reserves for their tokens. What will banks do in issuing their own tokens? Certainly is going to happen. Could they leverage others? Could there be a frenemy strategy? To be seen. But I think more of their customers in time will recognize that this is the superior payment rail. So to be seen again. Where does it play along the other traditional rails? That's something to be considered, right? Because there are no chargebacks. So that's something to be really mindful of. And then in time, I'll just leave this rhetorically, what will banks do to support this? So in terms of on and off ramps, if a customer wants to tap on a revolver and then fund it in a stable coin or pay offshore developers in stable coins, there's a lot that they might be able to do. I think there's something to be said as well as enabling clients to manage their true liquidity, at least in a single view. So seeing their fiat along their stable coins. So it's really exciting. I think there's more to come. But eventually I think there has to be kind of a convergence around what is the most utility, where are the most people, and where's the most liquidity. One thing I wanted to ask you before we wrap is just looking at the creation, I can't go back, but looking at the volumes as well. In addition to wallet creation and just more transactions occurring, what is some of that utility around yield and things like that you're seeing or you anticipate?
Yeah, so I think payments, of course, is like a no-brainer use case for stablecoins and remittances. But I think over time, what will really be important is what else can you do, with the stablecoins. And at Steakhouse Financial, we're basically building on-chain credit markets, starting with over-collateralized lending. So we have extended the use case for USDT and USDC through our vaults on Morpho, providing yield to lenders who want to tap into the on-chain leverage markets. And I can see over time how leveraging the front ends of let's say Revolut or Robinhood in time, if they launch their own stablecoins, then it would be really interesting to see them leveraging infrastructure like Morpho to extend the utility of these stablecoins in DeFi. So that's personally what I'm very excited about. And I think we'll probably end up working more with fintechs and traditional institutions in the next 5 years and work to bring DeFi more mainstream.
Yeah, totally makes sense. one thing I would just add in thinking about where the puck is going is who does what the best. So banks will probably play mostly where a license is helpful, and working with the actual final mile in the asset as well. But if things can be done on chain with less friction and peer to peer makes more sense, that probably doesn't need to go through a bank. That doesn't mean it won't, but I think thinking about, especially as we hopefully achieve more regulatory clarity and the passage of some legislation, I think it will naturally avail itself over time where the innovation occurs and where the different stakeholders place most of their chips.
Great. Unfortunately, we're out of time, but maybe if there's time for a couple of questions from the audience, feel free to raise your hand.
So love what you guys said about, let's say, how peer-to-peer and how it works in like local jurisdictions. How do you see something like, let's say, local stablecoins? Because P2P, let's say, transactions are a way to do the free market, black market rate. And local stablecoins will live in some kind of TradFi licensing world. And how do you compare like P2P transactions versus something like local stablecoins that would work with banking rails?
Well, I'm sorry, what exactly is the question? Just kind of a prediction, or?
It's kind of more like commentary on peer-to-peer transactions versus something like local stablecoins, which is like a common thread narrative being woven of recent.
Do you want to take that?
You mean local stablecoins as in like if banks were to issue their own stablecoins in certain jurisdictions?
You could, in the last panel, they were talking about, for instance, the Brazilian real, which would be a private institution banking dollars in a local bank issuing Brazilian real. Usually that would be done Brazilian real fiat for USD. Now you could own the Brazilian real and swap it for USD on chain. I'm commenting on like the swapping of Brazilian real for US versus Brazilian real P2P for USD.
You want to take this one?
Yeah, I think just from a first principles perspective, it's very much a compliance and a KYC question as well. So who are on both sides of the transaction, right? And what's the need ultimately in redemption? If the stablecoin is just a means to ultimately off-ramp into a local fiat currency, then introduce the traditional players. But if something can happen peer-to-peer where whether the two know each other or there's anonymity and KYC is less needed, or if the transaction amount is lower, that's probably better on chain. I think, of course, over time we will see more process just exactly on chain, but it's who are the parties interacting and what are their liquidity needs, and do they need to off-ramp now or later? Can they stay in that stable? It just really depends on the actual trade.
That's a good answer and exactly what I was looking for. Thank you very much.
I think from DeFi's perspective, we want these protocols to remain wholly permissionless, and the KYC layer would come, on top, where the integrators like the fintechs or the banks would be the ones responsible for conducting KYC according to their own processes. So yeah, I'm obviously a little bit closer to the DeFi side, and we promote permissionlessness as our ideology, but the practicality of integrating with the broader set of actors in finance probably means that there'll be various different KYCs imposed on even DeFi rails. Cool. Well, thanks everyone for listening.
Thank you.